Hello everyone and welcome to the continuation of my IAS 12 tax accounting course. In this video I will be talking about book to tax differences. Until now I'd started with introduction. I think we went on to talk about current taxes and a few other things. So in this session I will focus on book to tax differences. It's pretty much going to be a short video, maybe 10 minutes or thereabout. And this video is going to lay the foundation for deferred tax, which is the interesting bit of tax accounting. So pretty straightforward. So what are book to tax differences? So book to tax differences are the differences between your book income and your taxable income. Your book income is your net income reported in the income statement in a set of financial statements. And essentially your book income will be your profit before tax. Yeah, but sometimes you would have components of book income within OCI, but we'll get to that point in a much later video. But for the most part, your book income will be your profit before tax, and your taxable income is what it is. It's the taxable profit you've got in tax returns upon which tax is paid. So, and typically when you're doing a set of tax returns, tax computations, you will start with your tax. You will take your profit before tax and make certain adjustments based on the provision of the tax legislation up until when you get to taxable profit. So those items that you adjust are the differences between your book income and your taxable income, and you call those items book to tax differences. So I'm going to show you an illustration which you can see now to help you visualize what book to tax differences are. So this is the tax computations for Bed Limited for year ended 31 December 2023. They've got a profit before tax of $1 billion, and they have certain adjustment from depreciation to penalty and fines to impairment to export profit. They've also got unrealized foreign exchange gain, capital allowances, and all together they culminate into the number you've got here, which is your taxable profits of 727 billion. Yeah. And if you look at the legend below, you see that your book income is in yellow. That's a PBT. Your book to tax differences are the items in green, and so the items adjusting the PBT to get your taxable income. And of course, the taxable income is your taxable profit there. So pretty straightforward. This is how to identify what book to tax differences are. But it doesn't stop there. It's important to understand what kind of book to tax difference each of these items is. And broadly speaking, there are two categories of book to tax differences. You've got permanent differences and you've got temporary differences. And before I talk about what they mean, is that whether it's a permanent difference or a temporary difference, what these differences do is that they impact the size of your taxable profit and ultimately impact the amount of tax that you pay. So let's go back here. Assuming we had no adjustment, assuming we had nothing in green, your taxable profit would have been equal to the PBT of $1 billion. But as you have adjustments, the size of taxable profit changes and the size of the tax you pay to government changes. So what it means is that the book to tax difference impact the amount of tax that you pay here. But when it's a permanent difference, the only impact it has on your taxable profits is the current impact. The impact it has in the current tax returns. That's the only impact it has, whether it's increasing or decreasing, as the case may be. It only has that impact now, and that's what definition says, that permanent differences are discrepancies between your book income and taxable income that do not have a tax consequence in future period. That's it. It has a now impact, and that's all. But for temporary differences, they are the discrepancies between the book income and taxable income that are expected to reverse or be eliminated. So what we're saying is that if it's a temporary difference, it has an impact now, quite alright, but it also has a future impact. But sometimes the impact we can see now is itself the future impact of some prior, it's itself the future consequence of some prior impact that happened in the past. So the point to make is that if it's a temporary difference, the impact is not just in one period. It's in this current period and a future period, or a correction or a reversal or something that happened in a previous period. But if you look through the accounting standards, in this case IAS 12, you won't find the terminology permanent difference. It's an old terminology that no longer exists in modern day accounting standards, and the IFRS in the US GAAP. You won't find them there, but it's still relevant in practice to do your tax provision calculations, and that's why it's still relevant to talk about permanent differences. Yeah, and so that's it. So I'm going to show you an illustration to demonstrate temporary differences. In reality, if you look through the illustration I've been doing in the previous videos, many of those adjustments are actually permanent differences, things like penalties and fines. If there's no time in the future period, so if you have a profit of $1,000 and you have an adjustment for penalty for say $20, it is not deductible now. It will forever be non-deductible. There will be no time in future where there will be no later period where you can get a benefit, a deduction for penalty. It's a one-time impact and that's it. But for temporary difference, it's not that way. It has an impact now, but when things change, the impact will reverse. And these are temporary. And what it means is that because temporary difference have that potential to reverse, then altogether they do not have an impact on your tax expense. It's as if nothing happened. But then we'll get to the details of this when we're talking about deferred tax. But let's look at this illustration about Apex Limited, which is a company that generated $5 billion every year between year 1 and 5. Another year 1, it acquired a factory for $6 billion, which it depreciated on a straight line basis. And of course, if you depreciate $6 billion on a straight line basis for 5 years, that's $1.2 billion depreciation per year. It goes on to say that this company is based in Wakanda Republic, where the corporate tax rate is 20%. And in Wakanda Republic, the accounting depreciation is not tax deductible, which is normal in many jurisdictions across the world. And it goes on to say that they've got capital allowances that are deductible at the rate of 50% in the year of acquisition and 16.66% in years 2 to 4. So the question is to calculate the tax expense for years 1 to 5, ignoring deferred tax. And so you can see the PBT row, you've got $5 billion year on year profit before tax. You've got depreciation of $1.2 billion year on year, which culminates in the $6 billion cost of the asset. If you remember, you bought the asset for $6 billion and you have depreciated evenly for 5 years, $1.2 billion per year. Then you have capital allowances. If you go back to the question, it says capital allowance in year 1 is deducted at 50%, which is $3 billion, 50% of $6 billion, and the remainder you take them equally over the remainder 3 years, 2 to 4, year 2 to 4, and that's why you have $1 billion each. And then you have your taxable profits, and the next row, your tax rate, and your tax expense. Your tax expense in this case is your tax rate multiplied by taxable profit. That's your tax expense. 614 year 1, 1014 year 2, and that goes on to year 4. Year 5 is 1.24 billion, and you still have a total. And the total tax expense of 5 billion across the 5 years. And if you look at the effective tax rate on this basis, which is, you calculate your effective tax rate by doing expense divided by profits, and you see how the effective tax rate swings. But take a step back a little bit. If you look at the numbers, you see that the profits are equal year on year. Same profit year on year. If you look at it all together, over the 5-year period, the amount of your depreciation is exactly equal to your capital allowances. If you like, check the total column, exactly the same. So what it means is that from the day we bought the assets, yes, the law says we will not get a deduction for depreciation, but it lets us get a deduction for capital allowances. But what the law has done is that the law has said you can get a deduction unevenly. But based on our accounting policy, we're saying that we expect to get value from these assets on a fairly equal basis year on year over the next 5 years, and that's why we are depreciating equally. Yeah, but the tax has distorted that consistency in our expected use of the asset by asking us to take the benefits haphazardly from one year to the other. And that's why you see that the tax expense isn't consistent. Even though when you check at the end of the period, if you check the total, you will see that depreciation and capital allowance had zero impact on the total tax we have paid. You added back depreciation of 6 billion and you took a benefit of 6 billion capital allowances. So altogether, because they relate to the same asset, they have no impact. And so what tax accounting is trying to teach us is that we shouldn't let the haphazard nature of tax laws that distorts the way expenses are treated and income are treated, that should not impact how you book your tax expense from period to period. So if we're going to do different tax in this case, we would have completely ignored the impact of depreciation and capital allowances. And if we had done that, we would have had a tax expense of 1 billion dollars year on year. And that's what would have happened if we're doing different taxes. And that's what is expected to happen. You have to do different taxes anyway. So the point is, and that ties back to the accrual concept to say that you tie your expense, you book your expense in the period the profits are related to. The tax law does not allow us to align with that principle, because the tax law is saying you use 50% of the asset in year one, but we know that we're only using 20% in year one. So the tax law has distorted that, but we now need to do something else, which is deferred tax, to correct that distortion, such that we're booking our tax expense in the same period where the relevant profits have been made and the relevant expenses have been incurred. So like I said, this is just to lay foundation, and from the subsequent videos, I will go into sufficient detail to explain deferred tax. One more thing I should mention is that I have defined temporary differences in this video in a way that I thought is going to be simple to understand. But then if you go through the standard, which we will go through from the next video, the technical definition for temporary difference is significantly different from what this looks like. But altogether, at the end of the day, it has almost the same implication. And I think this way is easier to understand. But for the purpose of getting it right at all times, you will need to focus on the definition provided in the standard, which we'll begin to talk about from the next video. So at this point, I'll say thanks for listening to me. If you have questions, please feel free to drop it in the comment section, because from next video we'll get to build on the complexity, and it won't be as boring in quote as it has been in the beginning. It'll get a lot more interesting, but of course there will be lots of complex issues to talk about. So if you've got questions, please ask those questions now. Thank you and bye bye.